Jay Hatfield's with us, Chief Investment Officer, Infrastructure Capital Management. Jay, great to see you. We just were talking about some of the prints here today with GDP obviously coming down month over month, but more than expected. Durable goods unchanged after a surge that we saw in November. Claims tick a little bit higher. How do you interpret these pieces of economic data?
Thanks for having me on, Nicole. Well, I would focus the most on the inflation data. So PCE core was yet again 2% for the quarter, which is, of course, right on top of the Fed's arbitrary 2% target. And we're very bullish about PCE tomorrow. It's just for the month, being a little bit light. We're forecasting 0.15 versus 0.2. But more importantly, and this is the core of our bull case, is the roll down. So it's the base effect, and is another way of saying it. So this month we're at 0.4 year over year. A year ago it was 0.4. In January it's 0.5. So if we print what we've been printing in line over the last 6 months, we're going to roll down inflation by 0.3 this month, and then 0.2 this month, and then 0.3 next month. So we're going to have inflation's very close to 2.5, and that's when the Fed's going to start to feel the pressure to cut. So we would focus more. We think the economy's fine, so we're not too concerned whether GDP prints at 2 or 2.5. But this inflation data is critical. The Fed's only going to cut when it rolls down to something below 2.5. We're predicting June for the first cut.
I see. So June for the first cut. Are you okay with that? Does that feel like the right move to you based on soft landing or any recession or anything like that?
Well, the Fed sort of got bailed out. They were too hawkish, and then haven't cut soon enough, even though inflation really rolled over about a year and a half ago. It hasn't shown up in the numbers quite yet, but that's when housing started to cool off, which is a huge indicator of inflation. So the Fed should cut, but they've been bailed out by the fact we have a strong housing market, which normally causes a recession, is a weak housing market. So it doesn't really matter much. And we also do think that the ECB will be forced to cut before the Fed, and the long-term rates will probably go, to our target by year end, which is 3.25. So we actually see more upside risk to our 5,500 target than downside, because of this global roll down in inflation, global rate cuts. And in fact, President Lagarde was maybe not quite, but was dovish today in the press conference. And so that's a big change in tone. And so it's pretty obvious they're going to cut at the June meeting.
It was interesting because I heard some of her clips, and she basically said they were going to be pretty data dependent and that it was almost premature to start counting the cuts.
Yeah, so they went to the same school of central banking that our Fed did. So they believe in the Phillips curve, which is all about wages. There was a lot of obsession in the press conference about wages. When you really look, wages don't actually even really feed significantly into service inflation. It's really more driven by auto parts and insurance and other non-wage driven elements. But then nevertheless, that's their focus. But if you look at the data also in Europe, there's going to be a gigantic, even faster roll down in inflation in the ECB, in the Eurozone. Not in January, by the way, but February, March, April. So they're going to respond to that data. They just kind of want to see it. They believe in the expectations theory of inflation. So they want everybody to be cautious. So it's normal kind of central bank groupthink.
Yeah. So do you like financial stocks or certain financial stocks for investors at this point?
Yes, definitely. We think that people are ignoring something that's already occurring. We get approached on IPOs and debt offerings and preferred stock offerings. The calendar is very, very heavy for this time in January because some companies, are out of the issuance window because you have to have your, your documents in place and report, get your 10K for some companies. But so the activity is very high already, and nobody's really looking at the investment banks and their upside, because it's not just investment banking. It helps trading, it helps wealth management, it helps their entire business model. So like the Morgan Stanleys, Goldman Sachs, JP Morgans. And also if we have a bull market like we expect, then their asset management business just does better because the AUM goes up because the market's up. So those are the companies most levered to a bull market and also the least favored right now. So we think that they'll outperform the market as a whole.
Okay. Thank you. Jay, it's great to see you. Thank you so very much. Jay Hatfield, Infrastructure Capital Management.